All right, Dan, welcome back to the Dan Habib Show. Dan, how are you doing?
Doing great, man. It's been a volatile market to be navigating through, but certainly no lack of excitement.
We are very excited for the show team back with the Dan Habib Show in this different format. Today we're going to be tackling your guys' questions. Very excited. But first, become a MBS Highway member. Click the link in the pinned comment below. It'll take you directly to the website for all mortgage and real estate professionals. Also, become a CryptoCharged membership. I'm also heavily involved there. Click the link. It'll be right under the MBS Highway link. Use the code Habib. You will get a discount your first month, but we also have a 30-day free trial, no credit card required. And lastly, team, please subscribe and like this video. That greatly helps our channel. But today, your comments, your questions, your hot takes. Dan, are you ready?
Let's do it.
Michael Kogan says, houses have never in history been this unaffordable. Dan, your response?
Housing affordability has certainly gone down, but a lot of times when people are doing these types of metrics, they're not taking incomes into effect, right? So a lot of times people will try to look back to 2006 and they'll say how much home prices have gone up, how much the monthly payment has gone up. But you have to look over that same time period and say that, hey, incomes have also substantially gone up too. So I would argue that housing is less affordable when you take everything into totality than it was back during the housing bubble. But listen, no question, housing certainly has gotten less affordable. We've seen home prices go up significantly. We've seen interest rates go up towards 7%. So affordability has certainly dropped, but that doesn't necessarily mean that you're going to have a housing bubble. You know, if we had a glut of supply out there on the market, I would say we certainly are susceptible to seeing some big price declines. But there's just no inventory out there. Demand is waiting on the sidelines, but they just don't want to go from a 3% rate to a 7% rate. We're already seeing activity pick back up, which is why you've started to see home prices rise again. But just imagine what's going to happen when you start to see interest rates come down and the flood of demand that's going to come to the market. Believe it or not, counterintuitively, I think there's actually a lot of opportunity out there right now in the housing market.
Great insight, Dan. Yeah, I know Michael will respond to that because you gave your hot take about real estate and like buying a house right now with where rates are at right now. So thank you for that insight. The Luke Miller says, I thought you said we would have 5% by the beginning of the second quarter. Dan, did you say that?
I said exactly that. I think in the second half of this year, we'll see rates in the low fives. Now, that doesn't mean that we're going to get there at the very beginning of the second quarter. But if you look at some of the other insights in the video, it said that really starting May 10th is when I feel that we're going to see inflation, which is the main driver of mortgage rates, start to make big legs lower. Because we've seen inflation come down pretty substantially already. Remember, the consumer price index at one point was a little over 9%. Now it's at 5%. If you look at the producer price index, that was 11.7%. Now it's 2.7%. That's wholesale inflation. We've seen meaningful progress in inflation, but it is still too high. But the reason why we haven't seen better progress is because the single biggest component, shelter, is still lagging behind. What that means is that shelter costs have been increasing every single month within the inflation data when we know that they shouldn't be, because shelter costs in the real world have decelerated considerably really since November of 2021. So this is going to catch up. It's not going to be lagging behind forever. And the estimate is that by the May 10th inflation report, shelter costs will actually start to add deflationary pressure on a month-over-month basis. And when you have the biggest single component, instead of adding inflationary pressure, now starts to add deflationary pressure, that's going to help overall inflation come down, I think, to a much greater extent. When that occurs, I think you're going to see inflation come down and mortgage rates come down more substantially. Now, the start date was really like May 10th, not the destination. I do think that as we get through the second half of the year, nobody has an exact date on this, but I think through the second half of this year, you will indeed see mortgage rates on a 30-year fixed in the low fives.
Great insight, Dan. Armstrong_mortgage says, at the Dan Habib, which crypto exchanges can we trust?
Well, I don't like to trust any of them if I don't have to. And what I mean by that is that every single one of you, if you're investing in crypto and you're not actively trading it, you need to take that crypto off of exchange. Take that into self-custody. Use a Treasure wallet. Use a Ledger Nano X. The beauty of crypto is self-custody, where you don't have to leave it on an exchange. Remember, exchanges are marketplaces, just like TD Ameritrade is a marketplace. It's somewhere you can go to buy and sell assets, right? So I wouldn't leave my coins on an exchange. especially an exchange that's overseas, because you can run into scenarios like you had with FTX, where these are not regulated. You can have bad actors out there. You can think your money's safe somewhere, and then poof, they could be misappropriating funds and you get burned, right? So if I had to trust an exchange, and the ones that I use personally, I use Coinbase, because Coinbase, while you can't get access to all the coins, it is a U.S. publicly traded company. So I like my chances there best. But what I do is I take my assets, I bring them onto Coinbase, right? I will buy and sell there. And then when I'm done with that, let's say currently I'm holding, I take them and I transfer them to my wallet. And then I have no third-party counter risk. And then when I'm ready to go ahead and sell it, I will transfer them back to Coinbase into my wallet there. I will then make my sales of coins that I want to take some profits and then transfer that directly to my bank account in dollars.
Thank you for that, Dan. CJH Spence says, what our government manipulate the jobs numbers to make it seem like they're doing a great job? I think this has to do with
Yes.
earlier this year, Dan.
Yeah, so I'm sure of what he's talking about here. And listen, I am not one that likes to get into any kind of crazy conspiracy theories or anything like that. I don't even like to try to think about them purposely trying to manipulate the numbers, because then, listen, I'm a data guy. I'm looking through this data every single day to judge how the economy is going. If we can't rely on that, then I don't even want to try to think like that, right? So instead, I try to look at maybe some of the mistakes that were made. Now, you can certainly make an argument that there was some manipulations going on, but there's something in the jobs numbers specifically called seasonal adjustments and population controls. And clearly, they were wrongfully seasonally adjusting the numbers. They didn't make adjustments for the impacts of COVID and how that impacted the normal seasonality of jobs. And it made them overstate job growth, especially in the month of January, where you saw 517,000 job creations. However, the raw number was negative 2.5 million, which means that negative 2.5 million was your number that you actually got. But due to seasonal adjustments that you normally see during that time of the year, they made it go up by 3 million to get a positive 517,000. I think that was wrongfully done. I don't know that it was done with a negative intent. It may have been, okay, to maybe show. I mean, I could see people saying, oh, they want to show that there's a stronger economy than it is. You get into election season, things of that nature. I could see that. The other one is population controls. Population controls, this actually happens every year. So this isn't something that's new. But if you look at every January, it's normally 6 times the amount of job growth than you see through the rest of that year. Because what they do is they look at the population in January over the course of the previous year. They find all these illegal immigrant workers that they weren't counting, and then they lump them all into January, as opposed to doing what I think they should do and say, hey, we found these workers through 2022. Let's go ahead and appropriate them in the months that we actually found out, as opposed to lumping it into January of the next year. And I think disingenuously showing strength in the market, because listen, remember, these things have real world consequences. All of a sudden you see this really blowout jobs report in the month of January, all due to seasonal adjustments and population controls. The market reacts to that because the market's trying to handicap, hey, has the Fed done enough? Does the Fed have to hike more? All of a sudden you saw rates go from the low 6s to the low 7s in a matter of a month, because it was thought inflation's out of control still, job growth is still way too strong, the Fed's going to have to come and kill the economy more. So I don't like what was done there, but I try to steer away from any kind of conspiracy theories and just think that, hey, sometimes these people, they're people like everybody else, and they do things incorrectly.
Thank you, Dan. Let's move along here. Devin Anderson says, I just got off a job hunt after a layoff. There is a stupid amount of work available out there. I literally sat for 2 hours and turned down 5. Apparently he's got it easy here, Dan.
Well, good for Devin. I mean, I can't speak to somebody's specific qualifications, right? And of course, it's going to depend on how skilled of a worker you are, what area you're looking for. But largely, it does seem that you have a lot of open jobs out there, but then at the same time, you have companies complaining that they can't find skilled labor to fill those jobs, right? So there's definitely, I believe, a skills mismatch happening out there. But in any case, in any way you look at it, you're seeing the job hiring picture significantly slow. You're seeing the job openings now moving sharply lower. Still a decent amount out there, but the trend has been moving much slower. You've been seeing initial jobless claims, people filing for unemployment benefits for the first time. The 4-week moving average of that is moving to much higher levels that we haven't seen in quite some time. And you're also starting to see you're starting to see employers start to make cuts in other ways, meaning instead of laying off workers, they're cutting hours. So you're getting this, you still might have the same amount of workers, but the output is much less. That's another form of tightening and restriction, and I think inflection point in the jobs market. If you just look to the latest data we got for the month of March, we got that the first week of April, the job growth number was still decent at 236,000, but hours worked dropped by 1/10 of an hour. And they've actually dropped 4 out of the last 5 reports. The average work week now, it's not 40 hours, it's 34.4 hours is the average work week. Well, what does that mean from like an output standpoint? Well, if you were to appropriate, 1/10 of an hour, it doesn't sound like a lot, but there's 160 something million people in the labor force that on average, their hours have been dropped by 1/10 of an hour. If you were to say how many jobs would that equate to? Boy, it would equate to like 478,000 jobs. So if we actually saw that in the reflection of job creations, you would have seen a negative number there. But this is just another way of tightening. And you have to remember, just because we're seeing the unemployment rate at still pretty low levels at 3.5%, that does not mean that you can't have a slowdown and a recession. Everybody's waiting for the unemployment rate to be at a very high point before declaring a recession. It never works that way. If you look at every market cycle throughout history, when you see the unemployment rate at its lowest point and begin to turn higher, that's precisely when you get the beginning of the recession. And then, of course, throughout the recession, as things continue to slow, you see the unemployment rate really usually spike a lot higher. But don't be fooled by a low unemployment rate that we can't be in the beginnings of a recession.
Moving past jobs questions, Kay asks, real estate has maintenance and carrying costs. Stocks are basically transactional with less headaches. Again, going at your back and forth between stocks and real estate, Dan.
So it's an interesting take here, right? I mean, he's not wrong in that real estate can have carrying costs, but I'm not just. And by the way, in any of our videos that we've done, I've tried to make it pretty clear that I'm an investor in both stocks and real estate. I'm not saying that you should invest in one over the other. Like everything, I think it's good to have your hands in a lot of different markets for diversification, but they both have their cons and pros, right? So when we're talking about real estate, if you're going to buy the house, not rent it out, sure, there's a carrying cost there, right? If you're maybe trying to do a house flip or something like that, you're going to have your mortgage, you're going to have your taxes and such, right? And your maintenance. But what if I bought an investment property and I rented it out and now it's cash flowing positive? Well, now I'm making positive cash flow and they're paying down my equity. I'm gaining equity as they pay down my mortgage with that cash flow. And what if the home appreciates? Well, now you could be looking at a really exciting investment, right? So it's going to be situational depending on if it's a good rental investment decision or not. But the other thing that I think people don't realize is and I think this response was probably to this video, where everybody tries to just compare apples to apples. Hey, home prices went up 5%. The stock market went up 10%. It's better to invest in stocks. Well, first of all, the stock market can certainly be a lot more volatile than the housing market in a lot of cases. But not only that, there's something called leverage, and it's an important concept that you understand. When I buy a house, most people out there, especially when rates are lower, they're not paying for the house in cash, right? What they're doing is they're putting 5% down, 10% down, 20% down, right? In investment property, in most cases, it's probably 25% down on investment property. And, let's say it's a $100,000 home, just to use an example here. They're not putting $100,000 down like they would to invest in a stock. They're putting $25,000 down. And then, hey, if we were to see this thing appreciate, well, my out-of-pocket investment was only the $25,000. Now, if I'm renting it out and I'm making positive cash flow, that is what it is. If I'm having to carry that cost, it'll eat into your return. But because I'm only putting 10% down or whatever percent down you're putting, your returns can actually be a lot juicier than the stock market if you were to try to compare them truthfully and not just looking at the ultimate return of the housing market versus the ultimate return of the stock market. So again, this is conceptually speaking here, right? You can't just give a blanket answer for every scenario, but people forget about the concept of leverage. When you're investing in a stock, in most cases, hey, I'm going to put that whole investment amount in there, and then what happens. With a house, there's leverage. I put a portion of it down, and my return has to be calculated as such.
Gonzo says, in my opinion, there is no solution and the economy will collapse. Dan?
Yeah, I think it's certainly possible, but I think a better way that I would say it would be that there's no solution that I can see to get out of our current debt and deficit spending situation, right? You have over $30 trillion in, debt for the United States as a country, and we continue to deficit spend, which means we continue to spend more than we take in tax receipts, which is really the generating income that the country gets. So how do you get out of something like that? Right now, the only answer is to go into more debt, right? And that's what we continue to do. And you have the Fed that monetizes the debt, and you have the U.S. continue to get into more debt. So do I see a realistic solution for that problem? I don't. But I think it can continue to go on like it is. And it's scary, which is part of the reason why I think Bitcoin is something else that's good to have exposure to, right? Because instead of having a centralized finance system that has so much power to the Fed and the central government, you have Bitcoin that's completely decentralized. There's no inflation in Bitcoin. In fact, it's a deflationary asset as the supply gets cut in half, coming to market every 4 years. There's a finite amount in 21 million, of which over 90% has been mined already. And you don't have to rely on the Fed or banks to really create the flow of funds and really the price of money in our economy. So, but to Gonza's point, I think that this market cycle is going to end in a recession. I think we're going to see, in the second part of this year, you're going to start to see more of an earnings recession with companies. You're going to see the unemployment rate go up. You're going to see inflation come down. You're going to see economic growth go negative for at least 2 quarters, maybe even 3, second, third, and fourth quarter. I think there's a high probability of that. And I think you're going to probably see stock prices come down in sympathy with that. I think you're actually going to see real estate perform well because you're going to see mortgage rates come down. And there's a lot of pent-up demand on the sidelines that wants to get back involved. They're waiting for lower rates. You have no inventory. I think that, believe it or not, pushes housing prices a little bit higher. And I think cryptocurrency over the next year is going to perform very well as we lose some faith in the centralized banking system. Banking crisis lingers on. Maybe there's some more heads to fall there. And people see the value in decentralization and self-custody. And I think as you get closer to that halving of Bitcoin, which we just talked about, you always see ridiculous returns a little bit before and much more after that occurs. Because think about it like any asset. All of a sudden now, instead of 900 Bitcoins on average per day being created, since the reward gets cut in half, you only get 450 created. So deflationary asset, which will continue to be deflationary until you get to the finite number of 21 million. So, I don't necessarily see a solution to a lot of the problems that we're seeing either, Nick.
Wow, Dan, you're a beast, absolute beast, banging out all those questions. Dan, do you have any words of wisdom or advice to leave the team with today?
Words of wisdom. Man,
anything upcoming?
Well, I think, something big that I'm looking forward to seeing is what's going to be happening on May 10th. That's some big inflation data that we're going to be getting. And I'm hoping to see shelter costs, which appear to be cresting. I hope to see them start to move lower starting in that report, which I think will really start to see mortgage rates come down following that into the second half of the year. But other than that, I saw an interesting video, just not scrolling through social media, and it was about how we, spend all of our time working when we're, in this kind of prime working age that we're in, right? And like literally you can't work hard enough. You're spending all this time to establish yourself, to get yourself to where, you have a house, you can take care of your family, you're well established, right? Only to then try to do everything you can once you get established to get your time back, right? So the bottom line is that, our time is really the most valuable thing, right? So, everybody has like this like destination of where they envision themselves. Make sure you're enjoying yourself along the journey. We only get one kind of, go around at this earth, right? So make sure you run it till the wheels fall off, but, make sure you're enjoying the process. In my opinion, I think the definition of happiness is progress, right? So, I don't envision there being any kind of goal I set for myself that when I get there, I'm like, oh, my work here is done. I'm happy, right? But I try to have a positive attitude every day, and I try to make sure to celebrate the small wins. And whether that's in business, getting better, getting certain accomplishments, hitting certain goals, whether that's personal relationships, friendships, right? Consistently getting better every single day and improving, I think is the definition of happiness.
Wow, Dan, you almost made me tear up there. um, but other than that, team, please subscribe and like. Greatly helps us. But we're done here, Dan. So until next time, see ya.